Good morning, good afternoon, Arrive Nation, and thank you for finding time to join us today on our February episode of ARIVE Partner Spotlight. If you're joining from California, you get extra credits for battling snow and rain this week. ARIVE Partner Spotlight is a monthly webinar series in which we invite experts from our lender partners to discuss topics that can help grow and scale your business. I'm very excited to welcome one of our newer lender partners, ARC Home Loans, to today's Partner Spotlight. They joined ARIVE in September 2025. They are already live in our products and pricing engine, and deeper integrations with them are underway. ARC Home Loan is a non-QM focused lender, and that's the topic they will cover today. Why non-QM is no longer a niche, but it's your growth lane. Joining us from ARC Home is their Chief Production Officer with his team, John Gibson. John and I go back many, many years from Flagstar days, and we have built a strong relationship between ourselves. So again, we want to thank John and your team for the partnership with ARIVE. And without further ado, I will hand this over to you, John, to introduce your team, and let's go non-QM. And maybe, Amy, you want to make some housekeeping announcements?
Yes, just super quick. Thank you, team, for joining us today. To the audience, we are going to be recording this. So if there's anything that you want to touch up on afterwards or revisit, we will be sharing this replay in our Facebook group. We'll also be sending it out via email, and it will be on our YouTube channel. So just be posted probably next week. This will be available to everyone. Please put your questions in the Q&A. We'll be answering these in the Q&A, but also live as relevant. So just be interactive with us and engage, and we'll have a great session. So over to you, John.
Awesome. Well, thank you, Amy and Harish. I really appreciate being here today. And Harish, I think it goes even further back to that. It goes back to our Caliber when I was at Caliber too. So we had Caliber and then Flagstar and now ARC. So certainly have enjoyed our partnership where I've been and was excited to go live and ARIVE when we did kind of towards the end of third quarter, beginning of fourth quarter last year. And look, to everybody that joined, thanks for taking the time today. I know you may end up seeing this as a recording, but for those of you that are here, we certainly appreciate you carving out some time today to let us share some of our thoughts around non-QM and who we are and what we do, and more importantly, how it helps you, quite honestly. And I think we have some good content for you today around the non-QM space specifically, and more importantly, some of the things that may be misconceptions or myths out there, and really why you should probably look at it differently than you have in the past. But before we get there, I did want to, if you just real quick, introduce who I have with me, right? And let them kind of give a little bit of background on them real quick. So Louise Woods is one of our regional vice presidents. She is in that neck of the woods that Harish was talking about in California. So she's experiencing some of that weather too. So Louise, why don't you give everybody a little info on you?
Yeah, absolutely. Thanks, John. And thanks, Harish and Amy, for having us. We appreciate it. I'm Louise Woods. I've been with ARC for coming up on 6 years this summer. As John mentioned, I'm one of the VPs of production. So I run sales pretty much west of the Rockies, managing a team of AEs that, are out and about and hopefully doing their job well and training you all as to what non-QM can do. Been in the industry, I'm not going to overdate myself, but about 30 years. I know it's more. And the majority of my career, it's been in the sales side and or management of salespeople, but it's been in manual underwrite loans. So not, necessarily a Fannie Freddie background. I was big in the 203K days, the FHA days, the VA days. And then, of course, a big part of my career this last almost probably 8+ years has been non-QM. And really what I thrive at and I enjoy not only teaching our customers, but also, my AEs is, how to put a deal together and how to look past just a DU finding, how to get creative, how to make sure that the borrower is getting the deal that fits their needs, not just the deal that LO technically sells to everybody. So we really try and structure loans and help our clients, with the need that the borrower has. So that's just a little bit about me. I am out in California, so it's pouring rain here. And as Harish said, we got a ton of snow up in Tahoe this weekend. So we're getting a little weather here in California.
That's right. That's right. Lee, why don't you take a second to introduce yourself to the team that's going to be viewing this for us today.
Yeah, great. So I'm Lee Malone. I joined ARC last May, and really the whole purpose is to revamp and roll out our home equity product. So a lot of background in mortgage. I started the same time as Louise. We both started in the kindergarten mortgage program at our relative schools. So I've been in the industry for a while. I was a wholesale account executive in the Wells Fargo days before wholesale went away. And I was a longtime partner at PNC Bank as one of three regionals covering the bank's footprint for home equity, and then moved over to Guaranteed Rate to start up their home equity division about 3.5 years ago. So super excited to bring home equity to ARC and to share it with all of you today.
Yeah, and look, guys, those are the two subject matter experts, right? That's the brain power in this trio, right? I am the guy that kind of keeps the glue together here at ARC. I run all of production. As Harish mentioned earlier, did this in previous iterations at Caliber and Flagstar as well. And I will date myself. I did have hair when I started in this industry. At the end of the day, I've been doing it for 31 years now. Been at ARC for over the last year, and we're really excited here to be here today to kind of walk you through a couple things. But one of the things I just want to get out, right? Like, so we're on the same page is when you think of ARC, you should think non-QM. That is who we are. The company started 10 years ago, so we've been around for a very long time. And really kind of maybe not necessarily at the infancy, but right at the beginning of the whole non-QM movement, as I like to call it. And it is what we do. We specialize in non-QM. If you're doing business with us, you are doing a non-QM loan, you're doing a closed-end second, or you're doing a HELOC. That is what you're going to do business with us for. So on a day in and day out basis, everybody in this organization wakes up, eats, breathes, and then goes to sleep thinking about non-QM. But more importantly, around non-QM, how do we dispel some of the misconceptions? How do we make it a process in dealing with us that is easy for your borrowers? It's easy for you, lives up to your referral sources, obviously the people that are referring you business. And at the end of the day, that is who we are. We are a specialist in the non-QM space. We are in the top 10 from a non-QM space. And at the end of the day, there's nothing more that we love doing. Louise kind of really referenced it, right? Is working with you hand in hand to make sure that when you have those situations and those borrowers and those transactions, that we're literally holding your hand and helping you execute along the way to make you look as best as you possibly can to your borrowers, as well as your referral sources. So again, really happy to be here today. Can't say thank you enough for giving us the time. And let's kind of get into it. So look, I'm not going to read these slides verbatim, but I do think it's a good talking point for us. So I want to share a couple things with you today, right? Obviously, we're going to talk about some myths or misconceptions. I want to talk about some of the market intel that we see on a day in and day out, week in and week out, month over month, right? And really give you some what I call real life examples around transactions or loans that we've done for our business partners in the space that have helped them close loans like DSCR loans, like bank statement loans, like CPA loans. You keep going, asset depletion, asset utilization, keep going down that list when you think non-QM, right? I think that we're going to talk through a couple of the proof of concepts that we've seen from our business partners and share those with you. And then Lee's going to dive into our home EQ offering, which, look, I think is unique in the marketplace, right? And I'm not going to steal Lee's thunder. I'm going to let him talk about it. But we've really tried to structure an offering both from pricing, product, which we continue to enhance, as well as the overall process that we think is first in class, and literally competes with, some of those bigger boys that are out there that you've all come to know and love. But we do it in a fashion that I think is different, unique, and you'll see that when Lee gets to it. And then look, all along the way, we will answer any questions. I should stop for anybody in the Q&A. I don't see anything yet, but can you see these screens just to make sure that I'm doing this correctly?
Yep.
I'm seeing thumbs up from a couple people on, so we're good. All right, so look, let's get into this, right? So here's a couple myths, and I'll tag in and out with Louise because, like I said earlier, she's the brain power when it comes to this stuff compared to the guy named John. But I think, and Louise, we can get into this a little bit, right? Like, there's so many times when I go out and I visit clients with Louise out in California or anywhere in the country, visit you all, and I ask simple questions of like, hey, how many non-QM loans have you done? Have you ever done a DSCR loan? Have you ever done a bank statement loan? And I'm still shocked in 2026 how many originators, how many brokers I talk to that still haven't originated one. And I think we want to share with you 4 things that we traditionally hear. And Louise, let me know if I'm off base on this, right? Non-QM loans are too expensive. Couldn't be anything further from the truth. Louise, we were just out at the Waste Management hosting clients. What would you say to kind of this first myth or misconception?
Yeah, I mean, absolutely. We were out with a group of clients, like John said, at Waste Management golf tournament out in Arizona, and everybody was, having a good conversation. And one of the guys was talking about bank statement loans, and I was shocked. He's like, "Yeah, what's the rates on those?" And I was like, "Oh, we're in the sixes." And he's like, "Wait, the sixes?" And I said, "Yeah." And he goes, "Oh, I thought those things were a solid 8, 7 and 7/8, somewhere up in that." And I'm like, "That was years ago." I'm like, our bank statement loans sometimes are even better than a Fannie Freddie loan. I'm like, we gotta get in front of you and price these out and show you the way, kind of thing. And he said, "Yeah, I honestly don't sell them because I always thought the rates were so high."
Yeah, and look, gang, one of the things we're talking about on here, you can see, the conversation around agency LLPAs, right? With inside our non-QM product set, Louise talked about, a bank statement transaction or an alt doc program. We do a lot of DSCR volume. The other thing we do is what I call kind of like, we label it as an agency eligible transaction. I kind of liken it to it's our portfolio product. But if you think non-owner occupied, if you think second homes, if you think now, because we've morphed this program and added this to the agency eligible suite, primary transaction, primary residence where they're doing a cash out refinance. If you think about those are products that traditionally, when you start getting to that max LTV or within 5% of max LTV, and you start going down the FICO band more to like that 680-ish FICO range, you start to see significant LLPAs on an agency transaction from Fannie and Freddie. Well, with us on our portfolio product, that is one of the things where you have pretty good pricing power in the market compared to your competition. In using us, we eliminate those LLPAs, right? Because we're not actually turning around and selling them to Fannie and Freddie. So Louise, kind of hold me true, but I've seen scenarios where we've been upwards of 150 basis points better in price on one of those scenarios than what an agency delivery would look like.
Yeah, I mean, absolutely. We kind of nicknamed it out in the field as our Fannie Freddie lookalike, right? We're not really, I mean, we have Fannie Freddie products as our comb, but that's not our top seller. We're definitely a non-QM lender. So this is, to John's point, our portfolio product. But once again, when you price it, it doesn't have those loan level pricing adjustments that Fannie and Freddie do on non-owner, on second home, and on cash out. So therefore, it really puts that pricing ahead of the mark. And you'll see us in, a lot of the pricing engines here in ARIVE, you're going to see us hitting the top of the chart there on this product. So it's definitely something to consider and make sure that you keep us in mind for.
Yeah, and look, again, I don't think we're going to spend a lot of time on each word on the chart, but I do want you to focus for a second on what would be the gray section above the pricing. I think Louise did a good job kind of, hey, on a bank statement loan, you're getting down close into the low sixes, if not, depending on the scenario, you can actually get a 5 handle today.
Yeah.
So again, think that through, like a 24 or 12-month bank statement. self-employed borrower, can't qualify the traditional route, you're talking, somewhere with a six handle on the front, low sixes, pushing into the fives. That is not what the traditional thought process is when we talk to individuals. They think more, to Louise's points, I'm probably somewhere in the eights for this, which isn't the case. And you can kind of see, we gave you a real life example, right? This scenario was a 24-month bank statement loan with a 632 FICO. And this is a direct quote from one of our business partners, where you can see in that scenario, we were about 1 3/8 better priced. And you can walk through and see, like, they submitted it at 4 p.m. They got their income calculation back from us by the time they woke up. Knowing us, it was probably done within an hour or two of it being submitted, because we're pretty quick on those. And look, that's just proof, I think, goes a long way in you speaking to us about how we do. Louise, anything else on the expensive part of it or the myth? Because that's one of the biggest misconceptions.
Yeah, no, I mean, just as you said, I mean, these rates are fantastic, and even in today's world, we're getting into the high fives. So it's definitely something worth pricing. We do have a quick pricer on our website, so you can jump in there. But again, you can price right here in ARIVE as well. So you've got a lot of different ways to price, and yeah, check it out for sure.
Yeah, and to that point, we have an income calculation desk, right? That's jumping on these things right away. We're actually getting ready to roll out another vendor that we've partnered with, that many of you partner with when you're doing bank statement loans. So we should be able to roll that out in the next week. So again, we continue to expand the offering to help support you. So hey, with that being said, let's move on to the next one. All right, Louise, I'm going to ask you the question as if, again, I think we had some of this when we were at Waste Management last week, but the myth of individuals that have never done a non-QM loan, or maybe they hadn't had a bad experience with someone, that they just take too long to close. So why do I want to waste my time and drag my borrower through it, right? Thoughts on that, Louise?
Yeah, I mean, absolutely not true. We have, I think our average close time right now is something to the maybe 28 days, something like that. We do have a fast track program. So if for whatever reason you try to do a loan, whether it be Fannie Freddie or, another program, and it didn't work, a lot of the times we're getting fallout, right? Because we're helping you fix a problem. And so therefore we have a fast track program. You just reach out and we can close those loans, 15 days or less kind of thing. The DSCRs especially, I mean, they fly through. Once you have that appraisal, you're good to go pretty much on a DSCR. So those cruise through super quick. The bank statement loans, like I said, I think our average close time is somewhere in the 28-day range. So if you need to close a loan quickly, we definitely can help you with that.
Yeah, look, I think you did a good job hitting on all the points there, right? Like, I think you see on this chart, we're roughly 15 to 17 days. When I look back at all of 2025 and our production, on average, we closed in 15 to 17 days from registration to closing. Now, look, 40% of what we did last year, 40 to 45% of what we did last year was a DSCR loan, right? And those have a tendency to turn fairly quick compared to the rest of the non-QM loans. But I think Louise hit it on the head, right? We have a fast track program. We also have a concierge program. So talk about that for a second, right? Little unique. For all of our brand new business partners, when you start submitting loans with us, until we get through your first 5 loans that are dispositioned, so that could be funded, for some reason it didn't move forward, the borrower withdrew it. Unfortunately, sometimes a denial does happen or a counter offer happens. But until we get to 5 loans fully dispositioned, we actually have a concierge flag in our platform so that every single person touching that loan, from the opener to the account manager to the underwriter to the closer to the team in capital markets, your account and all of your loans are tagged as a concierge loan. Think extra TLC, extra touch points, extra proactive reaching out to you, because we know, it's not easy, right? Especially when you get signed on with a new lender, you got to learn process, technology, submission. We are there to hold your hand through that the entire time. And quite honestly, it's morphed into that's just who we are, right? But it is an official program, and we spent a lot of money revamping the system to make sure that you get flagged as a concierge client. Look, again, I think proof is more in the pudding of our business partners, so to speak, giving us the feedback that they've given us. So just real quick, I would point to DSCR loan closed in less than 25 days, offered fantastic rates, and now we're integrated in Arrive, right? That was a feedback from a client that was a joint client of us and Arrive. The middle one, DSCR loan, closed in 27 days. Again, the level of communication, the process, and how we respond. Look, we're not the company that's behind the black curtain, right? We want you to talk to our underwriters. Matter of fact, our underwriters will send out, before they send out the approval, they'll send you an email with their contact information, letting you know that, hey, thanks for the Smith loan. We're getting ready to send the approval. Here's my information. If you have any questions on the approval or the conditions, you obviously have your account manager, you have your account executive, but don't hesitate to reach out to me. And then look, a $1.65 million bank statement that funded in 9 days. And you can see there it was new construction. It actually blew out at another lender on this loan. We know that. And we got that from submission, disclosures out, and closed the loan in within a 3-week period. So sorry, clear to close to fund. We got it from clear to close to funding in 9 days, right? So look, I think that's one of the myths around non-QM. A, too expensive. I think we've tackled that. B, too long to close. Let's take a look at the next one. Can't be a major part of my business. I think, Louise, you and I have talked to so many LOs
Yeah.
around non-QM, and there is this apprehension or they're gun shy. I think some of it's a lack of education, right? And some of it's a lack of, I don't want to focus on this product, right? Because it might not be here for long. Well, guess what? That train has left. It is not going away. It continues to grow market share year over year of the overall volume that's being done in the mortgage space continues to grow. And I could give you statistics depending on which, economist or person you believe. It ranges anywhere from 10 to 17% of the market, with ideas that it could push into the 20s this year. But it is here to stay. It is not going away. And if you haven't paid attention to it, working with somebody like an ARC and our AEs who are solely focused on non-QM is a great place to start. But what do you think about this, Louise? You were laughing a little bit.
Yeah, well, it almost hurts my feelings, to be honest. Come on, guys. But no, if you're not offering non-QM as an actual product offering, you're really, not, you're doing yourself a disservice, right? You're just not out there working with the clients that are out there needing help. We talked to, if you think about it, right, from 2020 even, let's just go from, COVID forward, we're in 2026, we've had a 6-year run. To your point, these loans were around before then, but we're here 6 years in, we're staying, we're here to stay, and the products just keep getting better and better. But the one thing you have to remember is the borrowers have changed. They're not just your straight Fannie, Freddie, even FHA, VA borrowers. Loan amounts are higher. These loan amounts in non-QM world tend to be higher. They're upwards of 3.5 million. The income that they bring to the table, right? A lot of self-employment, or a lot of these people, have multiple jobs, right? Because in today's world, we all know life is getting expensive. So, you've got that nurse maybe that works a great job, has a W-2 income, but on the side, they're doing Uber, or they're doing Uber Eats, or maybe they opened up, a small online, boutique or something, and they're selling, beauty items, whatever. They have a self-employed job in addition to their regular. And with non-QM, you can get really, really creative on layering income, using full doc income with self-employed income, using savings for asset utilization, and all of these things can be combined together to get them to qualify. So really, when you look at borrowers and truly who are the borrowers today in our market, most of them have some sort of creative income source that needs to be considered to help them qualify to buy housing today.
Yeah, look, I think between the three of us, not including Amy or Harish on this call, just the three of us from ARC, I think we're at 92 years of mortgage experience in the industry. And here's what I would say, right? The more things change, I think the more they stay the same in some regards. And what I have told many LOs over the last year is, even if you never get a referral, or sell a non-QM loan. Take the time to educate yourself, understand it, because here's what it'll help you do, right? At the end of the day, refis are, we're all hoping, right? In 2026, we're hoping refis are coming back. I think I saw something the other day, not sure I believe it, but I think I saw something the other day that for like the first time, since probably the last 3 years, the number of unpaid balances related to mortgages, for the first time, there are more above, I think it was 5.75% or 6% than there were from the COVID years of the 2.5 to 3.5, right? So we've kind of equaled out now, right? At some point, we're probably never getting back to the COVID levels, but a refi, not wave, but a refi opportunity is going to increase and expose itself to a point where there's more opportunity, right? But in the interim, because we're not there yet, but in the interim, this is how you help replenish that book of business, right? Because here's what you do. Everybody's calling on your same referral sources, whether they're real estate agents, builders, accountants, financial planners, whatever it may be. Everybody's calling on those referral sources to keep that pipeline going, right? It's what you guys do to make a living. How do you separate yourself from your competition when you walk in and you're trying to have an appointment or you're on the phone? Talking about being able to do a self-employed borrower who needs to do bank statements. To Louise's point, there's so many different types of income that borrowers are now, earning that they can't qualify for a traditional Fannie Freddie loan. At the end of the day, to be able to tell, for example, a real estate agent, hey, I can do that. Or, hey, have you started working to increase your business on the investor side of the house because we have the DSCR program? Those type of things get your foot in the door. And all I care about, all Louise cares about, all we care about is you get your foot in the door so you're getting referrals from them. If it happens to be a non-QM loan, cool, we're going to compete for it because we think we're, best in class. But if you're using it to get your foot in the door, that's all that matters because you just want the referral, right? So look, on this one, $2.3 million worth of loans, right? 3 transactions, all for the same borrower, all funded on the same day. And you can see from our business partner, we exceeded expectations from registration to closing. Processor felt supported, terrific options, competitive pricing, and resources were a catalyst for submission. Look, we have account managers that are assigned to your account that are assigned to every AE. So when you're working with our AE, you're working with the same account manager. That account manager is an extension of the AE. They are there to support you every step of the way. We have a sales enablement team that helps train and support all of our clients. We have a Spark Assist team, which is there to help for any IT resources that you may be having. And Louise, am I forgetting anything else? I feel like there's more. What else am I missing from a support perspective?
Yeah, I mean, I think we've got, the website alone has, everything that you need to work with ARC, not only just like tutorials on how to use our system, but product and things like that. We are 100% transparent. Our guidelines, our full underwriting guide, as well as matrices are on the website. So we're not trying to hide anything. We're disclosing exactly what we can and can't do. Our AEs, a good portion of the ARC Home AEs have been here 3+ years and have been in the non-QM world for well over 5+. So you've got really seasoned, qualified AEs to help walk you through how to put these deals together, how to navigate non-QM. We have resources of, again, putting the bank statements in up front. So send us your bank statements. We'll calculate the income for you right up front before you even submit a loan. So you know exactly what income you can count on. All different kinds of things that, basically are leading to your success in closing these loans, quickly, efficiently, and keeping your borrowers happy.
Yeah, and look, I'll stop real quick. I saw there was a question in the Q&A. It looks like we answered it, but I'll throw it out there for everybody to hear it, right? It said, from Michelle Overstreet, it said, I had a client trying to do a bank statement loan, mid-FICO was 755. What are the borrower requirements? Obviously, Louise, I know you answered this, so I'll just read it for the group. We have both a 12-month and 24-month bank statement program, required to be self-employed for 2 years, provide the bank statements so we can calculate their self-employed income. You can upload bank statements to our website prior to submission, just like Louise said, and we will give you, in essence, what I call like a pre-flight and a pre-approval on, so you know what kind of income we're calculating based off of those bank statements. Okay, one more myth, and then I think we got some transition for you. This one I laugh about all the time. It's the subprime of 2008. Could not be anything further from the truth. I mean, these are all bound to ability to repay. Like if you've done them on this call, you know what I'm going to say next, right? Like these are run through just like, what I would call a QM loan from a standpoint of borrower's ability to repay and qualify for the loan. This is not the days of, put 20% down, put 25% down, put 30% down, fog a mirror and get a loan, right? Back in the day. That is not what this is. It has evolved into, I would actually argue, and I'll show you, well, I'll say it right now. Look at the statistics, right? Our average non-QM, well, I'm sorry, the average non-QM borrower has a FICO 776. In 2025, our weighted average FICO was north of, right around, actually, it was technically right around this number. I would say it was probably like 778. Average non-QM LTV in the marketplace is a 75. I just did the full Mythbuster presentation, which I had like 8 more for one of our clients up in New Jersey. Our weighted average LTV in 2025 was 68. So if you stop and look at, like, for example, non-QM on the total origination side, representing 8% of the overall transactions. By the way, if you guys get this presentation, there's links to the articles where these are quoted there. That's what that 1, 2, 3, and 4 are. And I just saw an article the other day about delinquencies in the non-QM space are at some of the lowest levels they've been at since non-QM came into the marketplace, right? So if you think about it, high LTV, so they're putting a lot of money down, good credit borrowers. A lot of these people are self-employed using bank statements to qualify, or they're investors doing DSCR loans. They don't walk away from those loans, right? They have a great credit history. They're good borrowers. But there is this misconception that it's the subprime market all over again. Louise, I know you and I were laughing about this out in Arizona too. Thoughts around this?
Yeah, I mean, to your point, I mean, we're looking at, higher down payments. I think that's the biggest difference, right? Is that, a lot of these loans we're looking at, we do 89.9, LTV, but 20% down or more are the majority of these loans. So they've got skin in the game. And then when you're looking at somebody's, let's say particular to bank statement, you're really seeing what the cash flow of their life is. So if anything, you're seeing a bigger picture than you are just running a full doc borrower through DU, right? Just looking at a pay stub and W-2. You're actually seeing, how their business is running, how they're managing money, and you're getting a really good insight to their financial responsibility. And not that that's how we're making our decision, but definitely it's the reason why we're willing to take risks with these borrowers, because we're looking at their overall financial health versus just their income. So yeah, it really does give us a quality borrower that's, paying their mortgage. I mean, the facts are there, right? The default ratios on these are very low.
Oh, and it was right there too. Sorry, I was looking down to the bottom right. Delinquency rates are less than 2%, right? In regards to this space. And again, if you get this presentation, you'll see delinquency rates. If you click on that, it takes you to the article. So we tried to reference that in the presentation for you. Look, I think Louise hit it really well. And at the end of the day, like, this isn't about the credit worthiness of these borrowers. They are credit qualifying, right? These are good borrowers. They just have non-traditional income profiles, right? And unlike in the past when subprime, I'll joke around and say a guy could work at Walmart as a greeter and say he made $10,000 a month. Like if they had 30% to put down, they were getting that loan, right? Like that is nowhere near what non-QM is, right? And then look, I actually love this excerpt from one of our business partners, right? Talks about being in operational roles for over a decade, dreaded the term non-QM, right? However, breath of fresh air, takes the dread and stress out of non-traditional lending when dealing with ARC, received impeccable service response from our AE, our account manager, every underwriter that they've worked with in the organization. Look, we really try to take the angst out of non-QM. Like, I have a couple sayings that I like using. One, and to me, it's like less clicks to close, right? How can we become more efficient for you in our process, in our system that you work in, to make sure that you're as efficient as possible? And if you're doing less in my system to get your loan through, then I think that's a better experience for you and your borrower, right? So we've built processes and procedures behind the scenes that jump in every step of the way to help you and guide you along the way. And in a lot of cases, we're already getting things done before you even know it needs to happen. Anything else you think, Louise, on the whole subprime conversation?
It's just not subprime, guys. It's non-QM, different world, different. Think of it maybe more like Alt-A is kind of the way I would go if I was to describe something from the past versus comparison. But it's its own thing, and thank goodness that it is, because it's really helping us close loans and put people in homes.
That's right. And then look, I'll throw out another question. I know we're answering them as they go, but just in case you're not looking at it, I want to make sure you see it or hear it at least. Can you lend a bank statement loan for a non-warrantable condo townhouse with less than 20% down? Answer is obviously 80% LTV is the current max LTV for non-warrantable condos on bank statements. We do non-warrantable condos all day long. Obviously, we have some LTV restrictions, 80 being the highest we'll go. There's another one, non-warrantable due to one party owns 22.5% of the units. We can look at that depending on the overall project size, loan amount, etc. Keep in mind, exceptions are possible with non-QM. And I'm glad you asked that question and Louise's answer. That is another thing that I think gets lost somehow in translation around non-QM. It is very much an exception, a loan by loan exception basis type of business, right? So just because we have published guides, we have multiple investors we sell to. As we mentioned earlier, we keep some of the stuff in-house, so to speak. But we have a whole credit team that looks at exceptions on a daily basis. And we continue to expand our credit box from a standpoint of our offering and what we will do. We're continuing to widen that box, but we're up to probably of all the exception requests we get on a monthly basis, which is into the hundreds, we're approving 54% of them at this point. We don't approve all of them, and quite honestly, some of them that get approved, there's a pricing hit for it, right? Like, it doesn't meet guidelines to do the exception, you're going to see a pricing hit for that, right? But don't think just because something doesn't meet a specific guideline, you shouldn't reach out to your account executive or your regional in Louise, because if you can kind of paint the picture, if you think of like old school when a lot of us got in this industry, if you can tell the story and we can back it up with supporting data, then we can go for exceptions, and we are doing them all the time. Okay, what else? Was there any other exceptions before we kick it? Do you offer a non-QM renovation loan? We currently do not. That is in the product development bubble. We've actually got some guidelines built out. We are looking at that. So, Mark, good question. Hopefully soon to come. Oh, and then, sorry, which bank is this? We are Arcom. There you go. Answered. And then, yeah, I think we got to all of them. So, all right. If you want, we're not going to do it today, but just reach out to us. We got like 8 other Mythbusters that we can go dive into. We picked what we believe are kind of the top 4. We're going to pivot now to HELOC. And look, I think it's important that we talk about this for a couple minutes because, as we mentioned before, right, I'm sure you've talked to a lot of your borrowers that you did a great job for during COVID, and they're in that 2.5 to 3 to 3.25% mortgage, and nobody's looking to get out of that unless they have to, right? Yet equity is at an all-time high. So how do you tap into it? So Lee, I'm going to stop stealing your thunder. That's my segue into you, brother.
Perfect. Sounds good. Go ahead and click the next slide for me, please.
Nope, you got to do it all off the top of your head, brother.
Perfect. Thank you. All right. So hello, everyone. So if today's meeting was strictly about let's get our heads together and get a whiteboard session going of what the perfect home equity environment would look like, I think you would find a lot of the things there in that center column, what would end up on our whiteboard, right? Consumer debt, all-time high. Mortgage rates remain higher than we would really like them to be. Customers are locked in on super low rates, like John just mentioned, but the equity is available in their home. And tappable equity just means equity in a person's home less than 80%. So they call that tappable equity. And what you see there in that blue chart there below is the mortgage debt's kind of in that bluish purple color. That's the mortgage debt. The red is non-housing debt. So that is anything such as credit cards, car loans, student loans, installment loans, all the other debt that, as you can see, some of these numbers, the Federal Reserve Bank of New York met last week, and these are up-to-date numbers that you see there from Q4. And that debt is just continuing to go higher and higher and higher. But what does that mean to you? The clients are still out there. And that's the thing that you have to remember. The clients are still out there, but your target has shifted. So if you've ever read the book, Who Moved My Cheese? That's what we are. And you need a big sign that says, you are here. You need that right there on top of that blue box there, because that's where we are. Like it or not, that's where we are. That's the environment we're in. And it's a perfect environment for home equity. Now, you might ask yourself, what does this mean to me, right? So if you're a broker on this call, you fall into probably one of three categories. One, I do HELOCs all the time. I love them. Well, guess what? We can help you with that. Two, I dabble, but I don't really market to my customers. I only do them when maybe someone asks me about it, or I've done a few, but I don't really market. I don't think a whole lot about home equity. Well, guess what? We can help you with that. We have a whole marketing side on our site that will do marketing flyers for you that you can completely customize, and we can introduce you to our marketing team that can review your websites and find out what you can do to improve and market to home equity, as well as just your regular mortgage business as well. Or three, you don't do them at all. I send them to my local bank or credit union, but maybe I do need to learn a little bit more about them. So you probably fit in one of those three categories, but the good news is we can help you with whichever scenario you're in. And as a loan provider for your customer, it's all about relationships. It's all about that customer thinking of you, my favorite broker when it comes to any kind of lending need that I have. Why would you want to send them to a local bank or a credit union just because you don't have enough information or you don't want to fool with it? That's where it's super important to kind of really dive in of what we have to offer. So definitely would encourage you to learn more about home equity, and that's what we can certainly provide to you. All right, so as we move forward here on the next slide, so where you find yourself with most lenders in the market, they fall on one of two sides of the parameters, right? You have some lenders that are out there that are all digital all the time. They do a really nice job when it works. The bad thing about those is it sometimes doesn't work, and your pull through is probably close to about 20%. So as a broker, what that means to you is now I have to package my customer up. It didn't work on the digital platform. I'm going to have to now shift gears and move it over to find another lender that is at the other end of the spectrum that is pretty much a manual process. And a lot of lenders out there that are still doing manual processes on HELOCs, and they do a great job. The problem is there's a whole lot of work that you as the broker have to do. Basically, there's a lot of first mortgage guidelines wrapped around a home equity product, and that's how those are getting done. So when I came to ARC, we wanted to decide what we can do as far as where do we fit in the market. All right. And we're kind of right there in the middle. And we've heard from our customers that, it's nice because you're a one-stop shop. We hear that a lot. And we start out as an all digital platform, very familiar with the digital platforms that are out there and available. We start out on that same path. But if it doesn't work, or we have to have somebody that has a second look or another review, or maybe they have some difficulty in their income, or not being able to verify it digitally, things like that, what can we do? Well, we built an off-ramp process that will shift those borrowers that can't completely go digital into more of a second look, where we actually have an underwriter, a team that's actually done loans in the past that has, can dive into that and can talk to you to try to make that customer work. To make that deal work for you. And that's what's really refreshing. We're kind of in the middle. We can go as fast as some of the digital lenders that are out there and it closes really quickly. Or if things run into a little bump or the customer can't digitally verify income, we can pull that back and take it more along the manual process. Now, the way we do that is there's three pieces of information that a broker would pretty much have to have in order to do a complete pre-approval, right? So the three keys are the value of their home, what's my customer's credit score, and what's the income. Well, what we do is a little bit different. So we do two of those three for you up front. We pull an AVM right up front, so you're going to know the value of their home. We also pull a soft credit score. So we're going to know the soft pull, we're going to know the value of their home. The piece that we don't know is income. And in order to get this to you in a really quick time frame within 3 to 5 minutes, we're going to assume a 50% DTI on that last piece. So we know the value, we know the score, we're going to assume a 50% DTI. And what that means to you as the broker is now you are super empowered with that information for your borrower to be able to tell them, hey, here's your rate. You asked for a $100,000 HELOC, but guess what? Based on your parameters, I can get you up to a $200,000 HELOC because our system will tell you the maximum amount that that customer would qualify for. So that's how we start out. And then we also have a nice quick pricing calculator that's out available to you on our website that you can plug in the numbers yourself, and just within a few minutes you can see our pricing. So that's really cool. It's one of the differences that really kind of makes us different than some of the lenders that are out there. And I will share with you, our pricing is amazing, and I'm sure you've heard that from lenders before. But I want to back it up. So I did a quick summary of just a couple of competitors out there in the marketplace right now, how we compared looking at their rate sheets. So all rate sheets within the last week and a half, 2 weeks. And we were beating these competitors by 1.5 to up to 3 points on exactly the same scenario, very cookie cutter scenario, $100,000 HELOC. I picked Florida based on those parameters and all the CLTV buckets that are out there. We were beating these two lenders out there. 1.5 all the way up to 3 points. So love the fact that I can back up our pricing, and happy to show that to you. I'll let you figure out who the lenders are that are out there, and happy to talk to you about that, in more detail. So, but love our product. I'm super proud of what we put together. I think it's a benefit to you as the broker because we want to keep you informed. We want to make it kind of like your best part-time job. That's how I always would explain this type of a product. Your main goal is to go out, get first mortgage business, meet with those realtors, and get that information up front. But the home equity piece is a way to do that. So if you don't hear anything else I say today, the main thing that you can use a home equity product for is a reason to call. It opens up doors for your past customers. It opens up your realtor connections. It opens up the ability to go into that shop, give them a 3-minute presentation of some new items, some new updates, things like that. And then hopefully you can go in there and earn their business. But if you're not marketing to your past customers, or you're not using HELOCs, you're really missing out on the boat. So I'm going to give you 2 things real quick that will open up pretty much any realtor door that are out there for you that's kind of unique to our product, and happy to discuss with you in further detail. But number 1, when you walk into a realtor's office, we don't require a condo questionnaire. So if you're in an area that does a lot of condos, and you know how much fun condo questionnaires are, you can go into that realtor office and just talk to them really quickly about, hey, we have a new product that we don't require a condo questionnaire. So does that mean non-mortgable condos? Yeah, absolutely. So make sure that you understand that piece of it. Number 2, again, kind of using this as a way to get into your realtor connections. We have a product that you can do a home equity loan on a departing residence. Okay, it's kind of like a hybrid bridge product. So as you know, our bridge products are painful. They're expensive. They take a long time. This one is great. We can do it in certain states where the home's listed for sale. The customer can take money out. They can make repairs on their home. They can pay off debt, update kitchens, things like that. Or they can put it down as a down payment on their new home. So a lot of great information. I don't want to bore you with all the details. I would definitely encourage you to set up some time with your local AE or myself, and we can dig into those and show you more.
Hey Lee, just because the property listed for sale is one of those big separators from our program to others, just give like a 30-second insight into the presentation we did for the one client, and I think it was Florida, if I remember right, where it was this epiphany moment where he also, I think, had a tie or owned a real estate agency, and just kind of talk about that for a second.
Yeah, absolutely. So great call out. So we were meeting with a broker. They set up a time to do a demo of our system. I brought that up, and it was like the whole room, their mouth just dropped open. And they're like, oh my gosh, there's so many times when we're helping our customers on our realtor side of the business that are trying to get in the home. They want to go ahead and secure that new property, but they're not able to do it and they're stressing out. So it takes that stress out. And they were super happy about that because they didn't find a solution that worked for them previously. It was always an expensive bridge loan. Well, the bridge loan would take you to another lender. And now you're hoping that your customer gets a great process and a smooth transaction with that other lender. You're putting that in someone else's hands where they were excited that they could control the whole conversation with their borrower. They control the process. The borrower got their money really quickly, and we can get funds in as quick as 5 days in certain cases. So they were ecstatic about knowing that connection, and it's really about getting them ready to buy that next home, right? Like it's getting that purchase secured is really the main goal of using this. And we do it without an EPO. They love that too because we realize it's a very quick turnaround. It's designed for a borrower that's hoping to move really quickly and get out of that other mortgage. So we do it without an EPO on that particular product as well.
Yeah, good input, Lee. And look, everybody on the call, as we kind of said with non-QM, right? It's a way to separate yourself from your competition and get your foot in the door. The HELOC product, not only for your existing or your borrowers, right? Your clients that you worked with, it's a great way to reach out to them, right? Like we said it earlier. This is what I call the refi of the last 2 years and will probably be the refi of at least 2026, right? And here's another misconception about these things. People feel like it's a $40,000 or $50,000 loan. It's not. Like our average HELOC that our business partners are supporting to us is pushing north of like 160,
Yep, right in that
150-ish, right
ballpark.
around that range.
Yep,
And we pay 200 basis points on these things, right?
absolutely.
So if you're doing a $150,000 loan, you get paid $3,000 and you quite honestly really have minimal interaction, right? Like you're going to be involved, but we're gonna hold in your hand and step in the borrower through it every step of the way. So don't get lost on these are like small 30, $40,000 loans. Like the borrowers that you put in loans 3, 4 years ago at 2, 3%, on average in this country, they have about $300,000 worth of equity. And as Lee mentioned, that debt is nothing but going up, right? So don't miss out on that. And if you're listening to Lee talking about figuring out who maybe those 2 or 3 people that we were doing our pricing compare against, I want you to stop and hear that again.
Yeah,
Depending on the scenario, it's anywhere from 150 to close to 300 basis points better in price.
absolutely.
Um,
And the reason behind that, John, too, I think it's
yeah.
fair to kind of bring up who our parent partner is. And there's a company called TPG, Angelo Gordon. If you don't know who they are, look them up, Google them. But they're one of the top two investors of all home equity products out there. So when you're selling to these other lenders that we're mentioning here, that's who the ultimate investor is of that product. Well, guess what? That's our rich uncle with deep pockets. That's the easy way to explain it. So they're the ones controlling our pricing, our margin, things like that. So that's why our pricing's phenomenal. We're not just another non-QM shop that's setting up a white label product for home equity. It's not like that at all. This is our product that we've built from scratch, and we have some great investment behind the scenes that are really driving and pushing this product home.
Hey,
So
John, I don't know if you guys seen the question, but a couple people are asking if you have a price comparison slide that you can share. I know we have it in our video that we do, but do you have one to share today?
I have one. It's got the other investors' names on it though, so I'm not
tell
sure.
you what, we'll follow up after the call and make sure we get it out to everybody. But yes, we do, quite honestly. We have scenarios and charts that we can show you. If you're not signed up with us, you're going to see in a second how to reach out to us. But if you are an approved partner of ours, reach out to your AE or quite honestly, you're going to see Lee's information in a second. Reach out to Lee.
Yeah.
He heads up our entire HELOC department. He is our subject matter expert on HELOCs. Okay, real quick, just kind of in closing, I want to go over a couple questions in case you didn't see them. They've been answered, but Nick, good question. Can you do anything on primary residence? It is. I know it's answered there, right? We're all across the board. It's primary, it's non-owner occupied, it's second home. So yes, these products all apply across the board. You followed up with I have a borrower with a 585 FICO at 55 LTV that needs 200K cash out. The only issue is 1 times 30 in the past. Obviously, Louise threw an answer out there. Minimum credit score is 620. They would need to get the score up. However, under our Clean Slate program, which is a version of one of our programs, we can take up to a 1 times 30. And then Somebody wrote, just to confirm, you can take a one-time 30 under clean slate with a 620 FICO. Great follow-up question. The guideline's actually 680 for the one times 30. The credit score goes up because of the one times 30. However, we would consider an exception as low as 620 with clean slate. So again, that's one of the ones, if you're approved with us, reach out to your AE and give them the details. Let them ask you the questions so we can kind of look at it to, will this work for an exception or not? If you're not approved, you'll see in a minute how you get there. Jared posted a link to some of our videos on Home EQ around our quick pricer, our scenario tool, which so you can see that in there if you want to kind of go deeper into that. Can you offer a HELOC and or fixed in first position or second position? Currently, we are only offering it in second position. However, Lee, correct me if I'm wrong, we're getting very close to the finish line of being able to offer our HELOC as a true first lien position.
Absolutely. Yeah, that's definitely in the product group right now. And that'll be coming out relatively soon. So we hope to hit by the end of the first quarter, but it might slide into early second quarter, but it's definitely on the radar for sure.
Angie, I think I know you. Thanks for the call out on the price comparison. We'll make sure we get that out to the group after the call. So look, just in kind of conclusion, Louise, I'll throw it to you real quick. Anything you want to kind of make sure everybody walks away with?
I just really want people to understand that both our non-QM products as well as our HELOCs, we should be out there marketing for them, right? We should be letting customers know that these are products that we offer and not just using them as a backup or a what if somebody comes across, my desk asking for a strange loan or a weird solution. And knowing that here at ARC, we 100%, we want to earn your business. We want to work with you on a regular basis, have a relationship with you, teach you the way, teach you how to market these. We're here to help. We want business partners. We want people that, really are vested in going out and selling non-QM products, HELOC products, and understanding what you're selling and knowing with confidence that you have a company, you have a team of people that are going to back you up to make sure that you're professional, you're successful, and you know what you're doing. We're happy to do any type of presentations with you, marketing with you. We'll go out to realtors. We'll go, do loan officer groups for training. Whatever you need to be successful in this space, we're here to help and partner with.
Yeah, absolutely. Lee, real quick question on HELOC product offering revolving lines of credit as well as closed-end terms. And then prepay in any terms. We could probably follow up with that because I know we're bumping up against the time. But anything you want to throw out at that real quick?
Yeah, real quick. So no prepays. Terms are your normal 10 all the way up to 30-year term. They do adjust with prime. So it's whenever the prime rate changes would be when the rate would change. Now there is a 3-year interest only draw period or a 5-year interest only draw period upfront. And we don't have currently a close-in second product, but that one is in the works as well. So.
Yeah, and I guess just to add on to that, right? We're doing the HELOC in the wholesale channel, so it's only for our brokers. Closed end second, we're doing in correspondent. Right. We are getting very close to the finish line of being able to offer closed end second and HELOC in all of our delivery types. So I didn't mention that in the beginning. I should have. We obviously do broker. We're in the non-delegated correspondent channel. And we do delegated correspondent too. And the other thing I didn't mention, we are strictly TPO. We have no retail, no direct to consumer. All we do is laser focus on the TPO relationship. And then look, guys, I would say thank you. I appreciate it. Great questions, Louise and Lee. Thanks for all the info. And just kind of in conclusion, right? One, we're extremely excited about being part of ARIVE. To Harish and Amy and the team, like I know we got through that in record time in regards to getting us into the marketplace. And now we've started phase 2, which when we're done, as you know, with other lenders, and we're going to get there soon, you won't have to come out of your ecosystem, i.e. ARIVE, to register the loan with us. We've already started with ARIVE's team and our team, and we're hoping to hopefully have that done here, maybe Q2-ish, sometime in Q2. I'll put quotations around Q2. But look, we really appreciate Harish and Amy letting us come on today, inviting us to be one of the partners that we had the spotlight on. We love doing this stuff. But I thought I'd just kind of end with a couple things, right? Number one, If you're not a partner yet and you're interested in finding out more information or getting some more information, you can reach out to me directly. My email is there. By all means, feel free. Anything related to HELOCs, closed-end seconds, reach out to Lee. There's his email. And I want to stop right there for 1 second because Lee mentioned something in passing. I want to highlight this. Our marketing team is here to support you. So I'll tell you 2 things. One, we created an in-depth, what we call home EQ playbook that literally we will give to you. And then all you have to do is follow it. It literally gives you all the materials. It tells you when to send the first one out to your book of business. It tells you what date to follow up on. It gives you the additional information. It gives you the touch points. It's literally a 30-day calendar of how you can market and reach back out to your previous book of business, right? Free. Like, it's yours. We'll give it to you. We'll walk you through it. And then look, the other thing he mentioned, and we've had a lot of customers take us up on this. Our marketing department will jump on the phone with you and literally give you a free review of your company's website, everything associated with that. They will do a chat GPT kind of education for you. Again, in a lot of cases, you're paying a third-party consultant to do that, to review. We'll do it for you for free as a business partner and give you our viewpoint from a marketing perspective. So just keep that in mind. But again, anything home EQ, which is what we call our HELOC product, and closed-end second, you got Lee's information. And then look, if you're not a business partner of ours already and you're interested, there's the way to get right to the page where you can find everything you need to become a partner at ARC. And for those of you that are seeing this, whether it was live or you're going to see it on a replay, if you're already an approved partner of ours, can't say thank you enough. We know you have choices. And we know how important it is when you entrust us with your borrower and your loan, what that means to you, your livelihood, not only your paycheck, your livelihood, your repeat business, your referral sources. So we take that very seriously. And as Louise said, we do treat this like a true partnership. Your voice is heard. And a lot of the things that we come out with and a lot of the processes that we evolve and change come directly from feedback from our business partners. So continue to give that to us. And we're excited for 2026 in relation to non-QM, our HELOC offering, and what we can do in partnership with ARIVE. So, Harish, Amy, I think that's all we got.
Yeah, thank you, John. We went slightly over time, but this has been such a phenomenal and educational session for all of us and our broker community. Thank you for sharing these tips, tricks, and strategies that can help our brokers grow. And thank you for putting more borrowers in their home of their dreams. So we appreciate also everyone who joined. It was such an engaging session with so many questions, and the recording will be available in a few days on ARIVE's YouTube channel. But thank you so much.
Well done.
Thanks, guys.
you.
Thank you.
Have a great day.